Or you think of, wow, tier one, that's like the best tier ever. It's going to stop any financial crisis from materializing because Basel III is like a genius bunch of financial planners who know exactly how to stabilize pyramids forever.
Over the weekend, despite soothing words and a 50 billion Swiss franc line of credit
50 billion Swiss francs
from the Swiss central bank, it was clear it was not enough to save the bank.
Thousands of investors who may have lost up to $50 billion.
$50 billion.
According to Madoff himself, the former NASDAQ chief allegedly confessed to his own sons that his investment business was a fraud.
55, 54, 53, 52, 51, oh God! 50! 50! Yeah, 50! Woo!
Not to 50!
You'd like to borrow $50,000 from our bank, but you have no collateral, you have no credit, you don't even have any ID. Is that correct?
That's right.
We don't have to bother with these formalities, do we, Mr. White? Huh? Just take what you want, Mr. White. Pay us back any time, or don't. We don't care.
Hey guys, Ralph here from the Endgame Investor, and I've got a little bit of a sexy voice today because I came down with the common COVID or cold, or whatever it is they call it these days. Now it's legal to get sick again, so that's great. Anyway, we're going to talk about Ponzi schemes and how we all hate Ponzi schemes. And another word for a Ponzi scheme is what? A pyramid scheme. And the entire financial system that is built on the fiat dollar is basically one giant Ponzi scheme.
One big damn conspiracy, and everyone's in on it, including her.
Once it starts falling over, then other Ponzi schemes within that giant Ponzi scheme get revealed. The weaker they are, the quicker they get revealed. What is the supplier of the Ponzi scheme? Well, you have the federal government and all governments basically that issue debt upon debt upon debt, and their central banks are the ones that keep buying that debt when no one else can. The central banks of the world are the ultimate Ponzi scheme suppliers, because a Ponzi scheme is when you have new investors pay off old investors, and once central banks pour money into the banking system, that is how depositors get their money when push comes to shove. And when the lender of last resort no longer lends, that is when the entire Ponzi scheme comes tumbling down, and only the people outside of the pyramid, which means gold and silver holders mostly, are outside of the effects of the Ponzi scheme. Not entirely. We get knock-on effects, but we are not in the pyramid because the entire pyramid is ultimately based on gold and silver. And speaking of gold and silver, if you want to add it to your stacks in the time of this banking crisis while supporting this channel and my work, you can call 855-GAME-END, which is the number that gives me credit for sales that are completed at MilesFranklin. You can also call their number on their website and mention me, Rafi Farber, as the guy who referred you to them. Why do I pick MilesFranklin? Because most of the people that I trust in the gold and silver space also affiliate with MilesFranklin, and I trust those people, and I trust the company, and I trust Andy Schefman, the CEO. Anyway, what is going on now is that in order to save Credit Suisse, and Credit Suisse must be saved because they are the counterparty to many derivative transactions worth trillions of dollars for other banks. If Credit Suisse falls, those derivative positions fall and other banks fall as a result. That's why Credit Suisse is a systemically important bank, which means that any and all laws will be circumvented through legalized trickery to save Credit Suisse and those derivative positions, and do anything to keep the biggest Ponzi scheme in the history of the world going for another few weeks. But there will be consequences to circumventing financial law in order to bail out Credit Suisse. Let's begin with what we're talking about here, which is AT1 bonds. This is a PDF from Lazard Asset Management in 2020, which describes what AT1 bonds are. Well, AT1 is the acronym. It stands for Additional Tier 1 Capital, and was introduced with Basel III after the financial crisis. Now, when you hear the word AT1, you think of a steak sauce.
A1 is how steak done.
Or you think of, wow, tier 1, that's like the best tier ever. It's going to stop any financial crisis from materializing because Basel III is like a genius bunch of financial planners who know exactly how to stabilize pyramids forever. But no, they don't. They're just Ponzi engineers to try to stabilize the pyramid for just a little bit longer and preserve that Ponzi scheme for just a few more months until they can bail out and go to some Pacific island and have fun. AT1. The AT1 market, it says here, is worth roughly $254 billion. What's the breakdown of AT1? That is, let's see, Lloyd's Banking Group, HSBC, Credit Suisse, UBS, SocGen, BNP Paribas. These are all extremely weak European banks, which are all on the verge of collapse, including UBS, which, if you look at its stock price, has not done very well since the financial crisis of 2008 either. Now, what does this have to do with Credit Suisse? Well, we know about the recent deal for UBS to acquire Credit Suisse for $3.25 billion. And that gives the equity holders of the bank some money, about maybe 75 cents a share or some paltry little number like that. And in order for that deal to go through, the Swiss National Bank, which can print Swiss francs, has promised a 50 billion Swiss franc credit line to Credit Suisse in order to get this deal done. And now it's up to about 100 billion, I think, but it was 50 billion, the same amount of money that Bernie Madoff lost in 2008, coincidentally. Here's the relevant paragraph. Under the terms of the deal, some Swiss franc 16 billion of Credit Suisse's additional tier 1 capital bonds, that's the AT1 bonds that we were talking about, which are designed to take losses when institutions run into trouble and to transfer the risk of a bank failure from taxpayers to investors, are being wiped out. So you have all these holders of AT1 bonds being wiped out. So then what do you think holders of other AT1 bonds of weak banks are going to do this week and next? They're going to dump their AT1 bond holdings onto the market, which is going to raise interest rates for these banks, which are already sick, and it's going to continue the banking crisis. Let's go to the next article. This is also from the FT. Title, holders of $17 billion of Credit Suisse bonds wiped out under UBS takeover. Several people involved in negotiating a deal said wiping out AT1 holders, a move that appeared to surprise markets, would have wider repercussions and was likely to lead to a sell-off of other bank debt. Traders quoting prices on Credit Suisse's AT1 bonds on Sunday afternoon had marked them up significantly after the Financial Times reported that UBS's takeover was confirmed, an expectation that the deal would not result in losses for bondholders. What FINMA, that's the Swiss financial regulatory group of idiots, has done breaking capital structure will have long-term consequences for any Swiss financial debt, said one Credit Suisse AT1 holder. One banker said the decision could lead to a nightmare in European debt markets, particularly given bondholders were having heavier losses forced on them than shareholders in Credit Suisse. Now, here's an article by Robin Wigglesworth.
When Mr. Bigglesworth gets upset, people die!
With a nice little boom on it, titled Credit Suisse's AT1s Vaporized. After all, if UBS was paying Credit Suisse shareholders $3 billion, then surely the AT1 bonds would be shielded. Couldn't possibly give the equity at least a consolation payment and fiddle with creditors, even if they are the most junior creditors possible. Surely. Whoops. Clearly, the Swiss regulators looked at the instruments and felt confident that they have the legal backing to vaporize the AT1s. When can they do this? When can they just wipe out bondholders on a whim? The standard threshold is when common equity tier 1 falls below 7%, but we think they can often be triggered at a national regulator's discretion, basically a whim. Basically, when they reckon, all they got to do is reckon, a bank is non-viable. And so when they reckon such, when they do this reckoning, and they decide that a bank is non-viable, then, all the debt holders of this bank get screwed over, or at least the AT1 debt holders of the bank, and the bank gets sold so it maintains its equity structure to another bank. Because what would have happened if the entire bank got liquidated and the remaining money was sent to junior creditors instead of having the capital structure of the bank intact? Then all of its derivatives positions would have been liquidated, and it would have spread a cascading failure across the entire global banking system. So this couldn't happen. So AT1 bondholders are therefore screwed over. And the message is going to be that if you are an AT1 bondholder of any bank, you are on the chopping block, which you should have known beforehand, which is why we say you should buy gold and silver, because there's no counterparty risk. The governments can't say that, oh, well, this bank is doing poorly, so I guess the gold and silver that you hold in your vault somewhere is now worthless. No, you can't do that. You can only do that to paper assets, which are part of the fiat Ponzi pyramid, just like the United States did to Russia by canceling its Forex reserves. But let's move on to what else the Federal Reserve is doing at the moment. What they're doing is basically swap lines, which means the Federal Reserve prints up as many dollars as other central banks want, and in exchange, those central banks swap the equivalent amount of foreign currency, and the two central banks swap. So there are more dollars in the international banking system. The Fed puts the Forex on its balance sheet. Its balance sheet expands. This is one step before QE. We've seen the central bank, the Federal Reserve, take on underwater bonds onto its balance sheet, about $300 billion worth last week. Now we are seeing it take up, we don't even know how much yet, foreign exchange reserves in exchange for dollars that other central banks need to bail out their own banks, including the Swiss National Bank, which needs dollars to bail out Credit Suisse and give it to UBS and all the other banks that need dollars now, because there's a cascading default chain going on in the international banking system right now. This article is from last week, March 15th, and I referred to this piece on the Silver Report at Arcadia Economics on Friday. Bank of England in emergency talks as crisis deepens at Credit Suisse. This was last week before the current moves had been made. The second paragraph here, the Bank of England was holding emergency talks with international counterparts on Wednesday night after shares in Credit Suisse plunged as much as 30%, spreading fear through the city of London that overshadowed Jeremy Hunt's maiden budget. You don't want to disturb maidens. So if you don't want to disturb any maidens, then you got to have swap lines. And those swap lines materialized today. March 19th, central banks announced new liquidity measures to ease banking crisis. This was the crisis talks that were being held in London with all the central bank counterparts. It says here, Federal Reserve and other global central banks have announced fresh measures to improve U.S. dollar liquidity as global financial markets reel from the turmoil hitting the banking sector. In a joint statement released on Sunday, the world's leading central banks said they will launch daily operations to make funding available via standing swap lines. Previously, those operations were conducted on a weekly basis. Now they're going to be every day. They're going to be swapping. It's going to be beautiful. Here's the announcement from the Federal Reserve. March 19th, 2023, coordinated central bank action to enhance the provision of U.S. dollar liquidity. The Bank of Canada, the Bank of England, the Bank of Japan, the European Central Bank, Federal Reserve, and the Swiss National Bank are today announcing a coordinated action of printing a bunch of money. And now, but look at this. This was pointed out to me by Monaco64. You see that date, March 19th, 2023? Well, look at this one. Whoa, 3 years ago today, March 19th, 2020, Federal Reserve announces the establishment of temporary, very temporary, not going to happen again, U.S. dollar liquidity arrangements with other central banks. Same thing. That time it was the Reserve Bank of Australia, Banco Central de Brazil, the Denmark's National Bank, the Bank of Korea, the Bank of Mexico, the Norwegian Bank, Reserve Bank of New Zealand, blah, blah, blah. And all the other central banks, they're all swapping currencies. They're all participating in the same circle jerk. Great. It's wonderful. The pyramid is blowing up, and soon it will blow apart. And the only thing that will be left, the paper assets gone, are the gold and silver upon which it was entirely based in the first place. So are we going to see some serious fireworks in the metals on Wednesday if and when the Fed decides not to raise rates or even to cut them? Well, it depends what happens today and tomorrow on the banking scene. We've seen First Republic Bank and other regional banks in the United States close at their lows on Friday and open up trading double-digit down in the pre-market. If we see more bank failures today and tomorrow, it is very likely that the Fed will cut rates. If they can hold it together for 2 more days, maybe we'll see a 25 basis point hike, but I'm not even sure about that. But if they don't raise or if they cut, the metals are going to explode higher, in my humble opinion. So if you don't have physical gold and silver yet, the time to acquire them is probably short. So if you want to support my work, you can go to MilesFranklin and buy your precious metals with them, 855-GAME-END, or call the phone number you see at this website and mention the Endgame Investor, Rafi Farber. Or you can become a subscriber to the Endgame Investor with a 2-week free trial, link in the description below, or become my patron on Patreon, where you'll get a weekly video on biblical commentary on monetary and economic policy topics. This week, we're going to go through the golden calf and what it has to do with bank derivatives. I'll see you guys probably on Wednesday when I'll do a video on whatever the Fed did regarding interest rates on March 22nd. See you guys in a few days.